In March 2020, central banks around the world cut rates to near zero, almost simultaneously. In the 12 months that followed, the global stock market recovered and surged to record highs. Wealth held in equities increased by trillions of dollars. The people who benefited most already owned significant assets. The people who did not own significant assets saw their purchasing power erode through the inflation that followed. Same policy decision, two completely different outcomes, depending on what you owned when the announcement was made. Every few months, a small group of people sits in a room and makes a decision that affects the financial position of every person, institution, and government on Earth. They decide whether to raise, lower, or hold an interest rate. The announcement is typically brief. The financial media covers it with charts and commentary. Most people note whether their mortgage might change and move on. But here is what is actually happening in the background of that announcement. A transfer of wealth, not a small one. Every rate change redistributes purchasing power between different categories of people, between borrowers and lenders, between asset holders and cash holders, between governments and citizens, between countries. The direction and magnitude of that transfer depend on which way rates moved and what each person owns. Most people experience the effects of rate changes without ever understanding the mechanism. They notice that mortgage payments are higher or lower. They notice that savings accounts pay more or less. They do not connect those changes to the broader redistribution of financial positions that is happening simultaneously across asset classes, currencies, and debt structures. By the end of this video, you will understand exactly what rates actually control, who benefits from each direction of movement, and what knowing this changes about how you position your own financial life. Let us start with what rates actually are and what they govern. To understand why rate changes transfer wealth, you first need to understand what the central bank interest rate actually controls. The central bank rate, called the federal funds rate in the United States, is the rate at which banks lend money to each other overnight. It is not directly the rate on your mortgage, your savings account, or your credit card, but it is the foundation that those rates are built on. When the central bank rate rises, borrowing costs across the entire economy rise with it. Mortgages become more expensive, car loans cost more, business loans cost more, and credit cards may adjust higher. And, critically, bonds and other fixed income instruments change value in response. Let us focus on that last point, because it is where the largest immediate wealth transfers occur. When interest rates rise, existing bonds lose value. Here is why. A bond is a fixed income instrument. You lend a government or corporation money at a specific interest rate, and they pay you that rate for the life of the bond. When you bought the bond, that rate was competitive with what else was available. Now, rates have risen. New bonds are being issued at higher rates. Your old bond, paying the lower rate, is worth less to any buyer because they can get a better rate elsewhere. The value of your bond falls. This relationship is direct and mathematical. Rising rates mean falling bond prices. Falling rates mean rising bond prices. This relationship, called bond duration risk, is one of the primary mechanisms by which rate changes transfer wealth between those who hold bonds and those who do not. Now, extend this principle beyond bonds. Rising rates increase the cost of mortgages. Higher mortgage costs reduce what buyers can afford to borrow. Reduced borrowing capacity puts downward pressure on property values, because the same property is now accessible to fewer buyers at the prevailing rate. Falling rates do the opposite. They expand what buyers can borrow, increasing demand, pushing property values upward. When rates fell to near zero in 2020 and 2021, the combination of cheap mortgages and expanded borrowing capacity drove property values upward sharply in many markets. People who already owned property saw large nominal gains in net worth. People who had been saving to enter the market found the entry point moved upward beyond them. The rate change itself, a single policy decision, created a distribution of winners and losers determined almost entirely by what people already owned at the moment it was announced. Let us now be specific about who stands on which side of each type of rate movement. When rates fall, a predictable set of beneficiaries emerge. First, and most directly, borrowers. Anyone with an existing variable rate loan sees their interest burden reduced immediately. Governments with large debt loads benefit because new debt can be refinanced at a lower cost. Corporations with variable rate debt or upcoming refinancing needs benefit similarly. Second, Equity investors. The relationship between interest rates and equity values is not perfectly direct, but the mechanism is well documented. When rates fall, several things happen simultaneously that tend to push equity prices higher. The cost of capital for corporations falls, improving their expected profitability on future investments. The discount rate applied to future earnings in equity valuation models falls, making those future earnings worth more in present value terms. Cash and bonds become less attractive relative to equities, driving money flows toward equity markets. Each of these forces, alone, creates upward pressure on equity prices. Together, their combined effect can be dramatic. The equity market surge following the 2020 rate cuts is the most recent large-scale example, but the relationship has been demonstrated across multiple rate-cutting cycles over decades. Third, property owners. As we covered in the previous section, lower rates expand borrowing capacity and push property values upward. Existing property owners experience capital gains without taking any action. They simply held a position that the rate change made more valuable. Now, consider who does not benefit when rates fall. Cash savers. The return on cash savings falls with the rate. In near-zero rate environments, cash savings pay almost nothing, while inflation continues eroding their purchasing power. Bondholders who purchased before the rate fell actually experience a gain. Their existing bonds are now worth more, as new bonds pay less. But if they hold those bonds to maturity, they are still receiving the original lower coupon in a world where prices are rising. Workers whose wages are set by contract or by slow-moving labor market dynamics do not automatically benefit from rate cuts. The benefit flows to asset owners first. Workers, if they benefit at all, benefit later and less directly, through employment effects, if lower rates stimulate economic activity enough to increase labor demand. The timeline of benefit is fundamentally different. Asset price gains are immediate and mathematical. Labor market benefits, if they arrive at all, arrive much later, through much more indirect mechanisms. This asymmetry of timing is one of the primary reasons why each rate-cutting cycle in recent decades has been associated with increased wealth inequality in the period immediately following the cut. Not because the policy is designed to produce that outcome necessarily, but because the mechanism reliably does. If understanding who benefits from falling rates just changed how you saw the 2020 and 2021 market surge. Stay with me, because falling rates are only one direction. Rising rates create a completely different set of winners and losers, and the mechanism running in that direction is where most people get surprised. That is what comes next. When rates rise, the redistribution runs in the opposite direction. Some of the same groups that benefited from falling rates now find themselves on the losing side of the transfer. Start with asset values. Rising rates put downward pressure on equity prices through the same mechanisms that falling rates push them up. The discount rate applied to future earnings rises, making those future earnings worth less in present value terms today. The cost of capital for corporations rises, reducing expected profitability on future investments. Money flows away from equities toward bonds, and cash as fixed income becomes more attractive relative to equity risk. Each of these forces creates downward pressure on equity prices. The 2022 rate hiking cycle illustrated this directly. As central banks raised rates aggressively to combat post-pandemic inflation, equity markets fell significantly across most developed economies. People who held large equity positions experienced significant nominal declines in portfolio value. Property values also came under pressure as higher mortgage rates reduced affordability and therefore demand. Now consider who benefits from rising rates. Savers. For the first time in over a decade, following the 2022 hikes, cash savings in high-yield accounts, money market funds, and treasury instruments were paying 4 to 5% annually. People who held significant cash savings suddenly had a meaningful real return available on that cash. New bond buyers also benefited, purchasing newly issued bonds at the higher rates rather than the near-zero coupons of the previous environment. Retirees and others living on fixed income from bonds and cash, a group that had been severely compressed by near-zero rates for over a decade, suddenly found their income position improved. Now here is the more complicated picture. Most ordinary workers were not significantly harmed by rising rates on their labor income directly. However, they were affected indirectly. Rising rates slow economic activity. Slower economic activity reduces labor demand over time. In the rate hiking cycle of 2022 and 2023, central banks explicitly acknowledged that reducing inflation through higher rates would likely increase unemployment, accepting some deterioration in labor market conditions as the cost of controlling prices. The workers who experienced that unemployment were not the same workers who owned the equity portfolios and property that fell in value. In most cases, they were people with fewer assets, smaller financial cushions, and less capacity to absorb a period of unemployment. Once again, same policy decision, different populations bearing the costs at different times in different ways. The pattern is consistent across rate cycles precisely because it is structural, not coincidental. Here is the rewritten text. Understanding rate cycles actually changes about your financial decisions. First, understand which side of the rate transfer you are currently on. If your primary financial position is cash and labor income with minimal asset ownership, you are structurally on the losing side of rate cuts and potentially on the neutral to slightly benefiting side of rate hikes through improved savings rates. If you hold significant equity and property assets with manageable fixed-rate debt, you are structurally on the benefiting side of rate cuts and the losing side of rate hikes in terms of asset values. This is not a recommendation to try to time rate cycles. Attempting to trade around rate decisions is extremely difficult, and the evidence that ordinary investors can do it consistently is thin. What it is a recommendation for this. Use periods of high rates to lock in returns on cash and bonds that were not available during low-rate periods. High-yield savings accounts, money market funds, and treasury instruments at 4 to 5% are significantly better than the same instruments at 0.1%. The window when they are available is rate cycle dependent. Second, understand that debt structure matters dramatically across rate cycles. Fixed-rate debt, a mortgage at a locked rate, provides certainty across cycles. You know your cost. Variable rate debt, a home equity line, adjustable rate mortgage, or credit card, means your cost moves with rates. In a rising rate environment, variable rate debt becomes more expensive in real time. Understanding which of your debts are fixed and which are variable is basic financial literacy that rate cycle awareness makes essential. Third, remember that the wealth transfer mechanism runs whether you understand it or not. A rate cut happens. Asset prices rise. Asset holders gain. You either participate in that gain because you hold assets, or you do not, because you do not. The mechanism does not wait for you to understand it before running. Understanding it is how you stop watching it happen to other people and start positioning to participate in it. Every time a central bank makes a rate announcement, a transfer of wealth occurs. The direction, the magnitude, the specific groups on each side of the transfer, these are not random. They follow a mechanism that has operated consistently across decades of rate cycles, in multiple countries, through multiple economic conditions. You are inside that mechanism, whether you understand it or not. Now you understand it. Share this with one person who watched a rate announcement last year and did not fully understand what just happened to their financial position. And if you want to keep understanding the mechanisms running through your financial life, subscribe to Hidden Truth Files. Hidden No More.